Gold and silver are boring now. Yes, silver has declined. It's declined relative to a lot of stuff since the top at 120, which is over here. So we are healthily below the 2021 low here in the gold to silver ratio, which means that silver is not really losing much value relative to gold. Both metals are in corrections right now, but silver not so much relative to gold. It still seems to be the leading metal. It's really the banks that are getting screwed because they have to maintain those rates if they're locked in, whereas it's the banks that are losing money on the mortgages rather than the people that live in the houses. Here, the oil wars could be responsible for the second wave rather than the first wave. The first wave was triggered by what? A virus war. BDSM unrealized losses hit worst levels since 2022, it says. So the private credit catastrophe is not over, it's getting worse. This is pretty bad, and according to Chevron and Exxon CEOs and other big head oil honchos, we've got a few weeks before oil spikes to about 150 or so. They could inventories of spare oil in the Western countries are at spectacular lows and they can't go. We're going to start with silver because I know you all love silver. So I took here a weekly candle chart going back 3 years, I think. Yeah, it looks like 3 years. So we see here's silver's rise in dollar terms, and we have a major triangle going on here since August of 2025, and we are reaching the apex of that triangle right now. You can see here is the lower trend line, here is the upper trend line, and we're reaching the point here where something's going to happen up or down. The reason that I think it's going to be up is that we've been coiling for 9 straight weeks just above the 20 EMA. That's the exponential moving average. That's something that I don't normally follow, but stock charts just put it in here on the default, and I think it looks pretty compelling.
Does it compel me? It's not that compelling.
1, 2, 3, 4, 5, counting candles, 6, 7, 8, 9, and this would be the 10th candle this week. The last time we saw that was over here, April 2025. That was the last time that silver was below $30 at all. And we had here a 1, 2, 3, 4, 5, 6, 7, 8, 9 week coil just above the same line. Does that mean the same thing is going to happen now? No, it doesn't, but it's happened before. And at some point it's going to happen again. Is this that point? Well, I guess we'll find out pretty soon. Next slide, silver holding at the 2020 highs versus the CRB. The CRB is a very old index of commodities going back to the 1970s. And you can see here that, yes, silver has declined. It's declined relative to a lot of stuff since the top at 120, which is over here.
Markets stayed calm while silver compressed into its 10th week near support. And historically, that's when attention arrives too late. According to Rafi Farber, this kind of prolonged compression above a key moving average has appeared before major repricings. But the bigger signal may be silver refusing to break against commodities despite broad weakness. Retail keeps waiting for confirmation, while institutions position during boredom. Wealth isn't usually lost in crashes, it's lost ignoring transitions. Next, Rafi Farber exposes why silver's relative strength matters more than the headline price.
But it has kept its 2020 highs relative to other commodities. We are now at about 0.2. And how does that look long term? Well, we have the long-term chart going back all the way to 2005 over here. And we are not only above the 2020 highs, we're above the 2011 highs. We're above pretty much all highs except for the recent highs that were hit at 0.38 when silver went to $120 an ounce. So we are, you can see here the tight coil above that same line right here, on the right side. But the point is that, yes, silver has declined, but not relative to other commodities. It continues to rise relative to other commodities because its monetary characteristics are slowly being peeled back like an onion.
You're like an onion, an outer layer of cocksucker, and when you peel it away, there is 10 more layers of cocksucker underneath.
What about versus stocks? How is silver performing versus stocks during this correction from $120 on January 29th? What is it? January 30th? Something like that. Well, we're still holding way above the 2020 highs relative to the S&P 500. And it looks like we have support over here at about 0.01. We have gone down by about half, 0.175. And that has to do with the extreme bubble in AI stocks, which will burst at some point. And when it does, It's not going to be pretty for a lot of people. So what about the gold to silver ratio? Well, we see here something pretty interesting that we're holding below 60. The lower this is, the higher silver's value is relative to gold. And so while we do see a correction here from a low of 45, well, that's cool. There's like an arrow here that spontaneously appears.
Markets climbed, yet silver held more value against commodities than many growth assets, and that divergence deserves attention. What Rafi Farber is highlighting isn't simply price resilience, but the possibility that silver's monetary role is returning while speculative capital crowds elsewhere. If silver remains above major relative support, while equities depend on narrow leadership, the official growth story becomes harder to trust. Portfolio damage often starts with assets that looked strongest first. Next, Rafi Farber unravels why the gold-silver relationship may contradict the AI-led prosperity narrative.
I didn't know that could do that. I don't know what is causing that, but I think it knows. I think there's like something in my computer and it knows where the gold to silver ratio hits its low right here. Wow, that's amazing. So below 60, and you can see here we are trending down still below this, again, 20 EMA on the gold to silver ratio. So we are healthily below the 2021 low here in the gold to silver ratio, which means that silver is not really losing much value relative to gold. Both metals are in corrections right now, but silver not so much relative to gold. It still seems to be the leading metal. Subprime car loan delinquencies all-time record. I didn't know this, but I ran into it on Trading Economics. It says here the share of U.S. subprime borrowers at least 60 days behind in their auto loans declined to 6.8% in February 2026, easing from 6.9% in January. So technically, the all-time record was in January. Now we're back down slightly to 6.8%, but you can see here the trend is clearly a lot higher, and this is where we were in 2008. We're well above that now. Car loan delinquencies are higher than they were during the 2008 financial crisis, and it's not just car loans. It's also credit card and student loans. They're both higher than they were at the 2008 peak. You can see here is the comparison. While total debt balance in delinquency was much higher in 2010 than it is now, you can still see here the biggest difference is mortgage, right? And the reason for that, why aren't there high mortgage delinquency levels? Because a lot of people locked in their rate in 2019, 2020.
Nobody's talking about delinquency records because equity indices still look healthy, but credit usually speaks first. Rafi Farber notes that subprime order stress remains above crisis-era levels, even after a slight pullback. And the uncomfortable question is why defensive metals are outperforming during supposed economic strength. Locked mortgage rates may be masking pressure rather than removing it. Savers tend to discover regime shifts only after liquidity disappears. Next, Rafi Farber reveals the contradiction between consumer stability narratives and underlying credit deterioration.
And it's really the banks that are getting screwed because they have to maintain those rates if they're locked in, whereas it's the banks that are losing money on the mortgages rather than the people that live in the houses. And that is arguably worse for stability, and it's going to collapse at some point. But we can see here, credit card is at 13.73 delinquency. Now we're about the same, 13.12. It's around the same area that we were in the 2008 financial crisis. And since this is the peak, you can say, yeah, it depends how you count it, but we're basically at that same level. Auto loan 5.01, now 5.6. Student loan 8.66, now 10.34. In a lot of ways, we're in a worse situation now, debt-wise, than we were during the 2008 financial crisis, which was triggered by debt, and so will the next financial crisis be. Hormuz is now super ultra mega blocked. This is the latest screenshot from HormuzStraightMonitor.com. You can see 0 trips transiting now, 0 throughput, 0% of normal. This is pretty bad, and according to Chevron and Exxon CEOs and other big head oil honchos, we've got a few weeks before oil spikes to about 150 or so. They could be wrong, but this is what they're saying because inventories of spare oil in the Western countries are at spectacular lows, and they can't go much lower without triggering a huge price spike, which is going to have to force demand destruction. We'll see if they're right. A double inflation wave sparked by oil war. Remember the 1970s? Well, that was a double inflation wave sparked by an oil war. It sounds pretty familiar. So we have here in 1973, this starts in actually 1972, to the peak in 1970, late 1974, early 1975 was 30 months. That was the first wave.
If energy spikes while consumer debt stays elevated, the damage won't begin on trading desks. It lands first in household balance sheets. Rafi Farber's argument suggests the more important stress signal isn't housing defaults, but pressure migrating onto bank balance sheets and unsecured credit. At the same time, markets continue pricing stability, while supply risks and debt metrics point elsewhere. Investors protecting purchasing power should watch liquidity, not headlines. Next, Rafi Farber reveals why inflation cycles rarely end after the first shock.
Then we had a 24-month lull from 1975 to about 1977. 24 months, about 2-year lull, and then we have the second wave over here. The oil war was actually in 1973, the Yom Kippur War in Israel. And now we have the same kind of thing, the Iran war involving Israel causing an inflation wave. But there were two here. There wasn't just one. The war was only a 3-week war, remember, in 1973. So this one has been a little bit longer. It could cause a worse problem, which it probably will. Or, cure, because we all need this monetary system to end. In order to do that, we need the dollar to die, and we need oil to rise for that to happen. So the double inflation wave sparked by oil war, this is moving the same chart from the 1970s to now. And now I don't have information beyond this bar here in 2026 because I'm not from the future, despite what people think.
I'm from the future. I came here in a time machine that you invented. Now I need your help to get back to the year 1985.
So we have wave one here, starts in June 2020. It's close to the length of the first wave of the 1970s, and then we have the longer lull here, but here is this the start of wave two, sparked by an oil war. Here, the oil war continues. Here, the oil war could be responsible for the second wave rather than the first wave. The first wave was triggered by what? A virus war. The one that saved everyone's lives. Thank all of the health professionals, etc. Thank you, COVIDiot, for saving all of our lives. And the last slide I'll get into is from Reuters. Unrealized losses at U.S. private credit lenders deepen. It's getting worse for the private credit catastrophe. And this article is by Patiraja Ruga Bhupathi.
Maluga, Luga, 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 Luga. One Maluga, 4 Lugas.
All right. Why don't I just call you Bob?
Don't know.
This happened before inflation expectations fully reset, and by the time consensus noticed, purchasing power had already moved. This is where Rafi Farber's thesis shifts from commodity speculation toward historical sequencing. Energy shocks often create pauses that look like relief before a second repricing phase emerges. That doesn't guarantee repetition, but it challenges the idea that one cooling period means the cycle is finished. Long-term investors should watch duration, not headlines. Next, Rafi Farber exposes the timing gap institutions monitor before reallocating into hard assets.
A Reuters analysis of 51 business development companies, or BDCs, better than BDSMs, showed aggregate unrealized losses equaled 2.35% of net asset value in the first quarter of 2026, the steepest quarterly hit since the second quarter of 2022. BDSM unrealized losses hit worst levels since 2022, it says. So the private credit catastrophe is not over, it's getting worse. And that's all I have to say about that. Gold and silver are boring now, which is probably why you should stack if you haven't stacked yet now, rather than when they are being bid up by monetary panickers. So get your gold and silver at Miles Franklin, get your dirty man safe, use the code ENDGAME10 at checkout, and check out the Endgame Investor on Substack for a discussion of the plumbing and why short-term interest rates are plummeting specifically now. There was a rule change that took place and that is now taking effect. How long is it going to last? We don't know, but it's not going to last forever because eventually there's going to be an end to this system and we're going to go back to money rather than credit, because there's nothing else to go back to divide the division of labor.
Anyone famous named Bob? Maluga, Luga, 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 Luga?
I doubt it.
Good.
The assets attracting the least excitement are often the ones institutions quietly revisit before conditions change. Rafi Farber notes that unrealized stress inside private credit continues building even while public markets project calm, and that disconnect deserves more attention than daily price action. When short-term funding conditions shift while hard assets stay ignored, the question becomes who is preparing and who is reacting. Boring phases rarely stay boring,